Good afternoon, everyone. BC Richfield here, coming to you live from London. It's just gone a couple of minutes past midday here, which makes it 1100 UTC. A big shout out to everybody joining the live stream today. See some real old school soldiers on here as well. Hans, Sebster, Nick, great to see you on here, and Hangry Patrick. Great to see you again, buddy. Hope you are doing well as your menagerie. So, guys, again, we are going to be looking at a bit more of education focus today on Monday. Geo, whack. Good morning, guys. Hands. My poker game. I tell you what, it's not as sharp as it used to be, Hands. It used to be on point, mate. But as you can see by the Twitter posts, it's very easy to get distracted, right? Yakuza Kana, good morning, my friend. Craig as well. And yeah, all very good here. Thanks, Whack. Had a really good weekend. Got a lot of really exciting stuff going on at the Nest at the moment in terms of crypto, but also traditional markets as well, which we've been doing a lot of work for, with some announcements that come out soon, which is going to be really exciting. So yeah, I'm super pumped. What I've done, I thought you'd appreciate that, Hans. What I've done is I've left all of my analysis on chart from the Bitcoin report of the weekend, right? What I've started to do is I've started to share some of these on Twitter as well, just little snippets of them. You can get the reports for free just by being a free member at the Nest as well. So you come on board on the free trial, try it out for a week, see if it's for you or not, find out what kind of membership level you want, or if you want to just stay free, you can stay in touch with the newsletter and also the reports. They're really, really handy and really useful because all the different analysts within my team or our team at the Nest all produce reports through different days throughout the week. So you get really, really good and varying kind of perspective. I'm really well, thanks, Craig. Hope you are too as well. RB Sniper 22, hello, and very happy to have you live as well, mate. So I'm not going to kind of mess around too much today, really. I just wanted to kind of give you my thoughts. What I've really been trying to do or trying to share with people on a Monday is kind of education, but I really wanted to be sort of more structured with it. So what I mean by that is, I don't want to kind of continually go over the same stuff. Some of it I think is really, really important to go over because it's all about repetition to make it, to build positive habits. But at the same time, I want to make sure we're covering bits and pieces that are obviously valuable for you, but also for some of the people that are new and people that are also, been coming to the stream for quite a while, for which very thankfully, we have a lot of people in that respect. So let me just get rid of the session breaks quickly. They're just those little dotted lines that go down the screen and they kind of separate our days out. So let's see what we can do with this. So this is going to be all of our current data, which is fine. Let's kind of zoom out and just let's get in this habit of kind of making sure that we're seeing our high time frame view first of all right? So it's going to be a little bit messier than we're used to, but in truth, I just want to kind of, rather than going over and spending so much time every day doing all the charts from scratch, which we do on a Wednesday and we'll do with any other charts, I think with Bitcoin, we want to kind of revisit this. So just ignore this for a minute. It will kind of get a little bit clearer as we kind of zoom in, or actually what I can do. Hey, buddy. How you doing? Good to see you. Here we go. Let's see if I can just try and get creative with this. And then what we'll do is we'll just draw this one back in. Right, so that's another weekly fair value gap. There we go. Just cleans it up a little bit, and then I'll add the other bits back into the stream. So I think the clearest and simplest way to kind of explain this for me is that I'm using the weekly as my highest form of time frame, right? And then I'm decanting down to a daily, which is my real kind of high time frame. That's where I'm taking my analysis based on the consideration of where I think the market is moving to, or where I think it's reaching for, right? So what does that mean? It means that basically, do we expect which direction do we expect the daily candle to expand to, or do we expect contraction? Do we expect price to range? Yeah, so consolidation. And there's different things that we can look at for that, right? So for example, if we ever see, and this is a lot as probably most relevant on the higher time frames, is when you see these larger expansive moves, they're often followed by consolidations, right? So we get a large move here, small consolidation, larger move again, and then look at these small bodied candles here, and it's Trader SZ. I know I say this a lot, but I've learned so much over the guy over the years. But he says something really interesting. I never really heard anybody say it before, which is small bodied candles. Yeah, candles like this, yeah, with the small bodies lead to big body candles, yeah, like these. And you can see another example here, small to big, yeah. Even in here, right, smaller bodies, large expansion, right? Now it's natural that when we get some kind of impulse move, some kind of expansion, that price then starts to range, yeah. You sometimes get really nice patterns like this, for example. This was really good, and I saw a lot of people use this very effectively. Something like this, for example. So you've got your falling wedge pattern, or you've got your bull flag. For example, bull flags, we're looking for them to tilt downwards, and then we have a higher percentage chance of a break to the upside. Obviously, nothing's ever guaranteed, but when you look at statistics of patterns and breakout plays, if that's the type of trader you are, it's very important to understand the statistics of it, because that's what you're going to build into your systems. Now, for me, I'm somebody that's looking much more from a kind of market balance and dynamic point of view. And what I mean by that is I'm trying to work out where the market's heading, where it's pricing to go, and where we're going to see, or where's the highest likelihood of us seeing a reaction that takes us to our overall target. So if we just look here on a weekly scale, right, and let's just start at the top here, right? Well, anywhere we're going to get a market structure shift or break, yeah? So we're coming down here, low, lower, high, lower, low, lower, high, lower, low, higher, high, higher, low, break above this, yeah? And then for me, I'm certainly thinking, well, okay, if we're showing strength above here and we can see the strong close that we get above this high, then I'm going to target this high next, right? So you might say, okay, well, how's that relevant? Or you look for highs above it. Well, it's really relevant, right? Because quite simply, this is the level, right? Now we've closed above this level on a weekly scale, and obviously we would look to decant this onto lower time frames. But if this then becomes our next target, and why is this our next target? Well, a couple of things. My expectation is for price to be searching out liquidity above old highs and lows, yeah? Especially if you have anything here like equal highs or lows, anywhere that could be considered engineered liquidity. Or it's looking to rebalance an inefficiency, right? A fair value gap. So when we see price, for example, come in and we see this drop, and then we get our structure break that we've got here, yeah? Now, obviously, we can take a more aggressive approach to this as well here, where we have a market structure shift, right? So this is the difference in terms of marking up whether we've got a shift in market structure or an actual confirmed break, okay? So this is our market structure shift, our MSS, right? And then this one here is our MSB, our market structure break, right? So for me, this is the definition between whether we've taken a shift in market structure, meaning the early phase but an unconfirmed move to change the dynamic of the market, or whether we've actually had that break, right? And let me just explain to you what the two different ones mean, yeah? So within here, what we'll notice is we're setting lower highs, lower lows, lower high, lower low, right? Now, when we break this high here, we've changed delivery, right? Because we've had a shift in market structure. We've gone from setting consistent lower highs and lower lows, being in a bearish market trend, to now shifting up and setting a higher high. Now, technically, that's not confirmed until we set a higher low and then break out. But what we can see here, and if I make this a lot fatter so it kind of stands out, right, is we've got two really pronounced areas here. We've got this shift, yeah, and then we've got this break. So within a shift in market structure, an area that's always of interest to me is the high from when we've shifted. Right? Now, why is that of interest? It's of interest because if we see price return to this level, yeah, especially after we've had a market structure sweep, yeah, a market sweep. So you have price come down, take liquidity, which it did below this low, and then it starts to get into a bullish structure. Then if this level holds, we're looking for this to provide a platform that price then pushes up from, right? So for me, I'm very much a confirmation trader. That's what I like to see. So even on that very, very kind of basic outlook of it, What it does is it then delivers us areas of interest. So when we have an area of interest, for me, a specific kind of area for that is a fair value gap. So let's use this one here as an example. We're going to draw this across. Let me know, by the way, guys, if this isn't particularly clear on your screen. And I can always make it a little bit bolder. So what's the importance of this here? Now, remember what I was saying before. We're either looking for price to deliver to old lows or highs. Why? Because that's where we believe stops to be resting. Yeah. So basically above here, there's going to be a load of buy stops. Why? Because people that were short here, their stop loss is a buy order. Breakout traders and algorithms that are programmed to take these breakout trades will buy at these levels, right? Meaning that they can be counter traded by institutional traders, smart money, as ICT would call it, for example, or just major players that want to take all this liquidity, all of these buy orders, and use them as counterparties to their sell orders, right? Meaning that when we run these key levels, as we see above here, stop losses, buy orders, right? All of these buy orders that are above here, and let's just represent this with some color. So all of these buy orders, all of these people being triggered or trapped or breaking out into going long, provide a wonderful liquidity target for major players to turn that to fill their sell orders and reverse the market. Now, why do they do that? Right? Why do we get these things called stop hunts or liquidity grabs? It's because big institutional buyers, sellers, the major players in this space are playing with huge sums of money. Right, retail traders, which is myself included, as well as probably all the other traders that you would see on CT, etc. These people, we're merely a drop in the ocean, right? You know, you're talking about hedge funds, you're talking about huge financial institutions. And the problem is, if they're going with the flow of the market, their orders are enough to move markets, and in most times, very, very considerably, right? Meaning that if they want to jump on a trend here, and they say, okay, well, let's wait for the market structure break, and then let's start entering here when we close above. They would move the market up so quickly, or they risk moving the market up so quickly, that actually, rather than their orders being here, all of a sudden they start getting slippage, right? And then their orders end up getting higher and higher, which wrecks their risk to reward. So why not try and control the market conditions to push the market where you want it to be, create the liquidity pool that you want to fit yours, and then make the market go in the opposite direction. All right. So just bearing that in mind, if we're targeting old highs and lows, that's one way we can look at that. Yeah. Institutionals are eating all the ants. Yeah, exactly. They're looking and positioning these accounts to generate enough liquidity from enough people to flip that on them and go in the opposite direction. Also, as well, didn't see you in there, guys. Good morning. Tammy, great to see you. And Moral, welcome back to the stream. Obviously, as well. Yakuza Kana, straight in there with a good point. So, fair value gaps, how do we use them, right? Now, as we've come up here, let's look at the point that I just discussed. And the reason that I'm covering this on the weekly, guys, is because we can cover it on any time frame, right? So the points of this are repeatable. Erica, hey, buddy, and Sebster, fantastic. Okay, just quickly before I go on to this, quick question here from Seb. Thanks. So MSS is higher high after high low, and then market judgment is both, then higher high followed by a higher low. Yeah, so probably easier for me to just show it in an example very quickly, just so that we get this on here, right? So if we've got market structure coming down like this, so we're bearish, right? So lower highs and lower lows, right? Now, what happens here is when we get the first break above this high, we're delivering differently, right? Meaning that we've now set a higher high. So we've gone from lower high, lower low, lower high, lower low, to higher high, right? So this is the shift. This means this is the early stage that we're looking for this to be a shift. Now, the problem is from here that price can just continue to do that, right? And it can get back into a bearish trend. So what we do for confirmation in terms of an actual break, is we're looking for lower highs, lower lows, right? We then get that first initial shift in market structure. The break then comes here, right? Because what we've done here is we've set the lower high, lower low, higher high, higher low, and then we're up, right? So the break of this is when you have your confirmation break and we move up. However, you can take early stage setups here, which is what I like to do. I like to use this point on a market structure shift, this early stage. If I see a very high energy move up here, leaving displacement, meaning that there's a fair value gap in here, then that's where I'm looking to take my entries, because on a higher time frame, what I can do is dive into a lower time frame, find a setup in there similar to this that allows me to get confirmation. Um, GOT, and is that, I absolutely love it if it is. Is that a Crichton? It is. It's Rimmer as Crichton, isn't it, on Red Dwarf? Literally one of my favourite shows of all time. So is it correct to say that a market structure shift is the same as a change of character? Exactly right. So yeah, very much an original student of ICT myself from many years ago. A lot of the principles that I use come from his teaching. Yeah, so that's absolutely right. So a cho-cho, which is known as a change of character, right, as ICT would teach it, and the market structure break is exactly the same of a break of structure. Yeah, exactly. So just slightly different analogies. Before I learned under ICT, I came from a very traditional market background, so I already had a lot of principles. I learned so much from Michael and in the course of ICT, the original core mentorship. I know there's been new material since, but he was a really big influence on me, as was like Trader SC and a few other people as well. But yeah, exactly the same principles, right? So as Gio's saying here, a change of character, which is also represented as a CH, small o CH, so a chocha, is basically this. It's an unconfirmed market structure move, meaning that we don't get the confirmation until we then set the next stage, which is either a market structure break or a BOS, which is a break of structure. All right. So that's really well raised there, my friend. Um, and this is a good point as well. Really helpful. I've gone long too early too many times. Yeah, for sure. Look, the truth of it is, though, the higher risk the move, the earlier the stage you get onto it, the more you increase your potential reward. Yeah. So as long as you know where your risk is, yeah, then you can take those moves, but you just have to study market conditions. So for me, I like to make sure that, say this is on a daily chart, yeah, this move here, and we draw into it, then what I'll do is get a magnifying glass on that. When we then draw down into this area, yeah, so let's just say, for example, this here is the big, this fair value gap here. Well, this now on a lower time frame, so let's say we move from a daily down to a 1 hour, yeah, then all of a sudden, this move that comes up here, I'm looking for this to repeat itself, but within this, yeah. So this fair value gap here on the higher time frame would be represented by this here on a lower time frame. We look for the interaction, we overlay the same pattern. That's exactly how I'm looking to trade it. All right. GOT, brilliant. Absolutely love Red Dwarf. Grew up on that. Used to have the whole collection on VHS, and in fact still do somewhere tucked away in the loft. Erica, it is great to have you on the stream, buddy. Thank you very much. And Kelly, you absolute superstar. For those that don't know or maybe haven't been on the stream before, Kelly is a patron of the streams, brings up some really good points, and tunes in all the way from New Zealand, which is silly o'clock in the morning for her. So what an absolute trooper. Always lovely to have you there, bud. And just a quick question here from Whack as well. So if the market structure break is confirmed after the market structure shift, you could expect to retrace into a possible fair value gap through that market structure break. Yeah, so okay, look, without getting too bogged down in this, I'll go back to the high time frame analysis in a minute, right? But let's just hide all of this for a second, right? And then we'll turn it all back on in a minute. But I'll show you exactly what I mean, because I see this time and time again. People really struggle with this, and there's absolutely no shame in it whatsoever. Let's just turn that off, right? And let's just, for example, let's go to a 15-minute chart, and we're going to use recency of price action, right? So we're not cherry picking anything. Yeah, we want to make sure that the stuff we're using is repeatable. Now, a lot of these are very much traditional market methods. So you're going to see a little bit more choppy, a little bit more volatility typically on Bitcoin than you would trading sort of Forex or traditional markets. But what we're looking for here, right, is exactly what we've just discussed. Yeah. So there's two different ways that you can take a setup. Now, I'm going to do this just based on a 15-minute chart so we can run through it quite quickly, right? But typically what you will do is you will take what's known as a high time frame point of interest, right? Be that an order block, a fair value gap, etc. Okay. So in fact, actually, what am I talking about? Let's just do this properly, right? Perfect. Okay, so let's look at it in terms of this, right? So when we come up here, we'll do a long example and we'll do a short example as well, right? So you see I've got the daily order block marked on the chart here. For me, this was the real key point of interest, right? That's why I wasn't trying to long here, wasn't necessarily trying to long here, yeah? What you will find, though, is in any price action, and let's just use this just as an example because we're here, right? Now, if we look at the key highs and the key lows, right? So if you know an area that you're targeting, price was clearly capped there, something stopped price there. So when we revisit that, we can see if we have any point of interest, right? You've got this low down here. So we monitor it when price engages with that as well. But we're either looking for these key highs and lows, yeah, or we're looking for price to be engaging with a fair value gap, yeah? So just using this little bit of price action that we've got here, price comes into this level, runs this, right? Now, we would obviously look for this on lower time frames, right? But let's just do this. Let's give a couple of examples so we're all on the same page, yeah? So high, higher, low, right? So this is the higher low. This is the higher low here, right? Now, price comes in, higher low, lower high, yeah? Breaking this now, we've gone from a lower high to setting a lower low, right? So within here, that's our market structure break. Now, what does that do? When we've broken market structure here, what's our theory? Our theory is that price is heading back to a fair value gap, yeah, or to a high or a low. So if we're now in a bearish market structure, we expect price to retrace to our fair value gap and then we target lower prices, right? So where would our target be? So once again, we're looking for price to head to fair value gaps or untapped highs and lows. So now, if from here, from this break, we're now in a bearish market structure, going higher high, higher low, lower high, lower low. Now, when we retrace to here, anytime we come into this fair value gap, right, until we either fulfill it, right, which we don't here, but anytime we come back and we revisit this, come back in here, we see the reaction, let's mark them up. What we're then looking for when we do that are our breakdown patterns on a lower time frame, yeah? So let's hit replay mode on. Thank you, Hans. Yeah, do smash the likes up, guys, if you are enjoying the content. It does help the Google algorithm and also for YouTube as well. So we're in here, right? Remember what we said. We've swept liquidity from the high. We've now got confirmation that we're breaking down. One other key thing, and I don't want to get too detailed about this, but I wouldn't have wanted to see that low swept before we had the pullback, right? I would still be monitoring it in the same way, but at the moment, I now know that when we have this first move back up into here, we've got liquidity resting here. So this becomes our high probability target. We see when we run this liquidity here, look what happens. We have a bullish reaction back up into here, right? So then again, we're saying, okay, is this defending price once again? And then we either look for it to be reclaimed. If price was to continue being bullish here, we would look for a reclaim of this and then to flip our bias to bullish, right? And that would then give us a bullish setup. However, we can see that we're just getting rejected here, yeah? So if we now drop down to a 15-minute chart, just for example, now what we're going to do is we're going to monitor this to see if we get our breakdown pattern. So remember exactly the same pattern again, yeah? Now, normally I would do this on a 5-minute, guys, but let's just take a look at the 15-minute. What do we need to see, right? We want to see price taking out some old highs. So what have we got here? We've got a sweep here. Also, as well, guys, do let me know if this isn't zoomed in enough. Let me just make this a little bit bigger, yeah? So look, we've got this high here. We also have this immediate high here. So let's just use this one, right? What have we got here? We have our sweep, yeah? We have our run on liquidity. That's really, really important. What do we then need to see? We need to see a shift, remember? A shift in market structure or a market structure break. Now, if this one, right, we just pop that on here, and now we're going to say, so we've got our sweep up here. Yeah, that means that high liquidity's been taken above it and we see this breakdown. This is so very important for how I trade, guys, right? So we've got our market structure shift, not a break yet, remember, because we've still got a higher high. This is only the first lower low. But what's really important here, remember what I said, we want to see a sweep on liquidity. We want to see an energetic move leaving displacement, right? That means a fair value gap. So here we have our FVG M15, yeah, our 15-minute fair value gap. So what's our premise? That confirms when this candle closes, right? So now we're saying, okay, well, where's our internal liquidity target? Yeah, meaning where's the first place that we would target if we're short here? And for me, it's these lows. So that would be my target one. There we go. So that'll be our target one, right? Ultimately, we've got this pre-made target two level down here. Yeah. So what we're looking for is we're saying, okay, if we get this displacement, we close with a fair value gap. We can set a limit order, yeah, on the fair value gap here. Then our stops go above the origin of the fair value gap, which is this candle's high or a little bit above this candle's high. And then we need to make sure that we've got risk to reward. So we're 1.3R to here. So I'm thinking, okay, well, as long as we hit target one, what can I do? I can do one of two things. I can either trim some profit and move my stops to entry, yeah? Or I can trim enough profit that covers my stop loss, yeah? Or I can choose to not do that and hold entirely for here, or I can choose to trim a little profit and then hold the position to here. It very much depends on your data and it very much depends on your system, right? But the idea and the principle is the same. We've moved from a higher time frame where we've established that we've had a market structure shift, in this case, an actual break. We've identified the inefficiency that's been left, yeah, the fair value gap. We've then said to ourselves, right, we will monitor price when it returns to this fair value gap, yeah? And then if we get the same pattern, yeah, sweep of liquidity, a breakdown with displacement, a retest of the fair value gap, yeah, then that's where we're going to look to go short, all right? Or long if it was in reverse, yeah? So, not to cherry pick, we've got a nice trade there. So what happens here, right? We can see, right? We get a very similar thing, but we haven't engaged with it here yet, remember? We put it up here, we said, okay, we're coming in, what happens? Price comes up. Do we get our breakdown here? We don't, because we don't get a shift, yeah? What happens here? Price breaks down, but we don't get a sweep. Yeah. So what would happen ultimately is it would keep us out of that move. If we triggered this move earlier, yeah, then we'll notice here that what we would have had was a sweep, let's just say of this higher. Right, then we're saying to ourselves, okay, well, what do we want to see then? We've seen the sweep of the higher, right, which has taken place. This kind of comes down and sweeps this in the same move, so you would have it on a lower time frame, or you'd be looking for the following structure shift, which you could have here. Price then leaves a fair value gap that we would target. Ultimately, price would have then stopped us out, right? So we were early with that move. And then we decant, we look back. Why do we have to have that? Why did that break down there? We need to accept, don't cherry pick these trades, guys. You will probably lose more trades than you'll win, but your risk to reward is what will give you a profitable system over time, right? So this trade here, we held from start to finish, just for example, to make the maths easy. We got call it 2.6R. Yeah. So forgetting fees, we've made 2.6. Let's just say for the ease of maths that our stop loss here, 1R is $100. So we've just made $260. Yeah. Now let's just say we entered this trade here and we've lost 1R. So we've lost $100, right? So we're still up 160. Now we're looking for the next trigger, right? And we're saying to ourselves, right, what have we got here? So equal highs here, yeah, which is a fantastic thing to target in terms of looking for a liquidity sweep, yeah. So we run the equal highs. What are we then looking for? We're then looking for a market structure shift, which we get here, yeah. We're then looking for price to leave a fair value gap, which we see in here. And ultimately, price just misses out on retracing to there, right? But if it hadn't, then remember what we were saying. Our initial target would be the obvious liquidity, which is resting here below this swing low before the expansion. And then we'd be looking down to the lows down here, okay? So what we would have seen with this trade, if it had retraced into here a few more pips, we would have seen it run to target one easily. we'd have a risk-free trade, and we would have made a little bit of money. All right. So, but we didn't trigger it, right? So no cherry picking. Then we're saying to ourselves, okay, where's our next opportunity? We see the next arrow in here. What do? We get a clear and obvious liquidity run, not just of this high, right? But of this high back here. Yeah. So when we have something like that and we see a really strong reaction, don't ignore the reaction that's on the chart, guys. Yeah. We can see this long tail wick to the highs. And then what do we get? We want to see a breakdown, which we get our market structure shift here. We leave a fair value gap here that ultimately we don't retrace to. However, what we have the luxury of here is seeing that we are a long way away from taking out our initial liquidity here. We also have liquidity resting here, and ultimately we know we've got targets down here and further down. So what we can do, and again, this will play into your specific system, we can then look to take a secondary entry. So price comes down into here, we don't retrace into this. Yeah. What we do is we set this order block. Yeah, which is our 15-minute order block. So let's not get lazy. We would mark that OBM15 so we know when we're reviewing it on different time frames. Now, what's the principle here? We want to see price drive through a low, which we've done here. When we did this on the way down, did we leave a fair value gap? We did, right? So we look at this fair value gap. We mark it up. Now look at the confluence we have here. As we've set this fair value gap here before price is retraced, we know we have an order block here defending price. The point of this is we want to see these order blocks, the bearish order blocks, which is a bullish candle. I know that sounds confusing, but it's a bullish order block. Yeah, a bullish candle, sorry, that's a bearish order block. We want to see these defend price, right? So what do I mean by that? Well, when we're breaking down here, what you notice is, you see this order block? What happened here? When price broke below that, see how price got rejected as it retraced here? Yeah? So we're looking for the same principle with this. Now, what we know here is that we've got a clean target above here, and we're saying, well, if our theory is correct and we want to go short from this fair value gap, yeah, then we would be short from the very start of it, which is here, from the baseline. I certainly would anyway. And then what we're looking to do here is I would have my stops a few pips above the order block. Because look, if we reclaim the order block and start breaking above that, then I'm pretty sure that my theory on that is incorrect. And then I just need to make sure that I've got reasonable risk at my lowest, my first internal target, which is here, 1.3R. Perfect. If I'm concerned about that, like I said, I can flip my stop to entry when we get here and take enough money to cover the fees. But ultimately, we know that we've got targets resting down here and as far down as here. And what you notice, or what I hope you're noticing with that, is that as we go through here, just using these trade examples off of one higher time frame point of interest, we've had one successful trade because we know we're trading with the bias, right? We know our high time frame bias is bearish. We're not looking to long into this, yeah? We can counter trade it, but why not trade with the trend, yeah? So winning trade, nice 2.6R. A losing trade here because we swept, we came back up to take more liquidity, no problem. Would have had a winning trade here, but our entry methodology didn't quite trigger. We came a few pips away. Again, not a problem. We just need to understand the data. But ultimately, all of that liquidity is building for this much larger move that even if we put our stops to entry at target 1, yeah, target 2, none of these would have given us any reason to close the position, right? Now, remember what we were saying up here, or what I was saying, sorry, about order blocks defending price? So as we drop down here, now in terms of order block theory, I very, very much recommend that you go away, do homework on that in terms of what it means to you. I've built a lot of my knowledge around ICT and his teaching of order blocks. I've also learned off a lot of other people in terms of their theories on it to make my own kind of assessments on that. And I think it's really important that you guys do the same. But there's different parameters that I will use. But basically, in a nutshell, once you've had an expansive move lower, right, and we set, in this case, the first up candle, then what I'm doing is I'm looking at this consolidation that comes into here. I want to see this defend price, right? And especially focusing on the equilibrium, so the 50%. Yeah, and what we can see here is see how when price gets below it, it's really struggling to close back above. It's pushing up, pushing up. Now, if we did start to close back above, I wouldn't necessarily just get out of the trade there, but I'd be aware of it. And then if we started to recover market structure and push up here, I can look to either close the position out or I can just look to move my stop loss down a little bit so that if it does trigger out, I'm not going to lose any money. All right. Now, just quickly before I go on any further, I know there was a few questions that I've kind of maybe run through there. So, Sebster, how do I change time frame and stay in the same location? Really good question. Use replay mode. Yeah. So you see this up here. When you click that, yeah, and when you're in replay mode, you click this. If you just jump to where you are on the chart, yeah, and let me just go back to where we were. Right here we were on the 4 hour, yeah. So we've come here and we want to say to ourselves, right, okay, we want to find out what's going on here. We go into replay mode, either pressing that or if you're already on it, pressing this. And then you can click wherever you want to go. Say we want to go here, for example, right? And then it takes you through to that moment, and then you can decant that down onto different time frames as you would want them, and it keeps you in that place. Sometimes if you're going too far back and you're trying to decant down onto too lower time frames, it can be problematical because there's not enough data, but you'll kind of work that out as you go. And then from here, you can, click play and choose the speed that you want to see the chart replay at. So that way you can start kind of trying to build your analysis. It's a really, really, really good way to back test, right? Because you can just pull price back to a specific point or just to a random point even, yeah, carry out your analysis and then actually look to execute the trades in real time, yeah, which is a really, really good way to practice, all right? So, I mean, hopefully that's been clear in terms of how we're kind of using that flow. Let me just catch up on a few of the other questions quickly, guys, before we plow ahead. So, yeah, FEG, how we change location. Kelly, daylight savings now. God, good God. I mean, when do we even go into that? I mean, I'm so bad with that. Being in the UK, we're either UTC level or UTC +1, and it still messes me up. But you're still an absolute soldier for being up on this stream at what now is, 11:40 p.m. But sometimes Kelly joins the stream at like the early hours. Yakuza, sorry I missed that, mate. Hope the meeting goes well. So Whack, again, hopefully kind of cleared that off. Use replay mode if you want to move back to a certain point in the chart. When you looked at the order block, was there a fair value gap there as well? Yeah, often there is. And actually, for me, it gives more validity to an order block if it's followed by a fair value gap. Yeah, because it shows price really aggressively moving away. Now, something like this order block here as well, I really like because we set the order block. Yeah, we then have a FVG here. Yeah, hang on a sec. TradingView's been a bit twitchy. So we set this order block. Yeah, same way as when we set this one, the last up candle. Then we have a breakaway, yeah, and then we have a fair value gap afterwards. But this, for me, is the perfect order block, right? Because we've set the up candle. We've had a small, but albeit displacement within this candle, meaning a fair value gap. Then price retests it and then shoots away, meaning that when price revisits that area, it becomes another point of interest, all right? As in like just change the interval without going to the thing. So like this, you just type it in. Yeah. So any minutes are just the numbers. So 15 up from whatever you want, 1 to 66 or whatever random. If you want hourly, you just put the H after it. If you want daily, it's a D, and weekly is a W, and then it will move you to the respective charts. RB Sniper, there was an example where your order was just not filled. How long do you keep that order open, and when do you close it and search for the next one? That is a brilliant question. So for me, I base it all on my targets. Yeah. So, and it really is a fantastic question, right? Because as we're in here, we see, and this is the move that the RB Sniper's talking about here, right? Is we see when we have this. Hang on, let me just. I don't know why it's been so slow today. Right, so we see we have this move here, yeah? Price comes up, we take liquidity, and we then have our market structure shift here, yeah? Now this in here, which I'll just do a different color quickly so it stands out, that's our bearish order block, bearish fair value gap, right? Meaning that we expect price to retrace there, before going lower. Now, for me, I'm saying to myself, right, if we don't retrace to that, when am I comfortable leaving that order open till? Because once we set this fair value gap, I've got a limit order on the bottom of that, yeah? So, first of all, I'm conscious of this. So if we run the first key liquidity target, which is here, and especially the second in terms of internal targets, meaning that the external target will always be the beginning or the end of the move. Yeah, so this price leg here, we can see this is where we went from bearish to bullish. So my extended target or my key target would be this. This would be basically the range high up here and the range low down here. So that's my external target. My internal targets are here and here. Yeah. Now, when we get this move and we fail to tag this, then once we've reached my initial target, then I'll cancel that order, right? If I think the initial target's too close, it's one that I would expect us to run, and I've got my high time frame conviction, then I would close the order once we've reached this target. Okay. Now it's up to you what you consider your internal targets. You can obviously use order blocks. This, for example, this order block here, this bullish order block before this move higher, they can be good areas to target, or naked highs and lows, and you can even use fair value gaps. But a way that you can kind of get rid of some of the noise sometimes is move to a higher time frame. Yeah, so in this case, we're only moving up to the hourly. But you see here, when we move to the hourly, it can all just seem a little bit clearer. You can see that this one's quite pronounced, this one as well, and then this one down here. So to answer your question, mate, once we've done that, once we've started to make a move away from the original entry, which in this case is our little pink box, which we'll just draw back to, once we've moved away from that, once we've run our first liquidity target, then I close that position off. All right. But really, really good question. Let's have a look. Yeah, good question. Yeah, no, there's loads of these little hacks that you can put on there, Seb. Really, really interesting ones as well. Kelly, have you done an order block live or video? I'm struggling to find decent video that explains it well. If you do, what is the date so I can go back and watch it? No, but I mean, I can certainly do one. I'd be happy to make one, or maybe if you're about for the stream on Wednesday or next Monday, let me know and we'll do a live session on order blocks and what my theory on them. What I would really recommend is to look at ICT's material on that. Whether you take the whole course or not, I would just type into YouTube ICT order blocks. And I think he has just such an exceptional view on that in terms of looking at it from a price delivery perspective. And that's certainly where I've kind of got most of my learning from. So I would always look for that. But like I say, happy very much to kind of share how I use them and how I've adapted them over the years. But I would say if I had to kind of accredit a source of information for that and a lot of other things, I would say ICT is a real go-to. So you can just go to YouTube, type in ICT order blocks, and then you're good to rock and roll. Davis A. Thank you, mate. Yeah, that's really, really kind of you. So a couple of questions when you can. How do you get your candles to look like that? Both wicks and colours? No problem. Have you got your screen open? Can you take a screenshot of that? So just double click on your chart, and then go to symbols. And then that is my entire setup here. Really, really easily. Top left one is white and the rest are black pretty much. So let me know. If not, just grab me and ping me a message on Twitter. For anybody that wants to reach me on Twitter, you can reach me at BC_Richfield. Come and grab me on Twitter, or if you're a member at the Nest or want to take on a free membership, come and grab me over there. And anything like that, just give me a nudge. I can take a picture and then pop it over to you. All right. Going to have a look at Link and Soul warming the lunch. Brilliant. Well, write down what your thoughts are on Link and Soul, mate, because we can cover them for sure on Wednesday when we do our alt request show. RB Sniper, you're very welcome. Well, Seb, we're actually going to start running some live trading sessions soon, especially on like Forex and crypto. We're going to start trading the New York session with you guys. So I'm going to hopefully get live 2-3 times a week. And we'll be doing that. Be running most of the sessions with the crew at the Nest, but I'll certainly try and do at least one public one with you guys every week for sure. Yusuf, fair value gaps, are they one-time use like the supply and demand zones? We use them one time only. Really good question. Okay, so I actually use fair value gaps in a bit of a different way to that. Yeah, so uh, basically, what I'm looking for a fair value gap is for it to be filled. Yeah, so once it's filled, so let's see if we can just find a good example here. Actually, all right. So let's look at this one here. Now, two good examples here. Actually, I'll show you the two different ways that I'd look to use this. So, you have to bear with me a second, actually. I know TradingView's being super twitchy. Right, so here we go. Now, this one here, I'm just going to do this in green to show it as a bullish fair value gap. Yeah. Now, what we're looking for is when price retraces into this, we want to see a bullish reaction. Yeah. And then our theory is that basically we're then looking for long positions as this holds. Again, you can mark in the equilibrium as well, so you make sure you don't see any closes below. But as this holds, we can then confidently take long positions targeting the next obvious liquidity at the highs. Yeah. So we've run liquidity into the low here. We've retraced down into a fair value gap. We start to build market structure, which we'd look for on a lower time frame. Ultimately, we come and take out this high. Right. Now, another way that we can use fair value gaps. Right. So actually, to put that one back there, there's two different ways that I would then use this. I would use this as an inverse fair value gap. So once we break through it, yeah. Now, once this has been filled, if you break through it very quickly and then you look to retrace to it, you can look for short setups. All right. Now, this works better for me with more recency, right? So basically, this has gone on for quite a while, right? This has also been filled here. So then when we return to it, there's an argument of, well, okay, is that the most relevant fair value gap? Yeah. And for me, it's not. Yeah. For me, if I was then looking for that, I'd be looking for recency in here, because when price breaks down to here and sets this fair value gap, well, first of all, this is bearish, right? So we see what happens. Price is breaking down lower highs, lower lows. We targeted this fair value gap here with this wick, which breaks us down to here. We've then targeted this fair value gap here when this drives in, and then we break lower. Then when we break down here, when we see this fair value gap, well, the theory should be the same, right? Price should be drawing back into this and rejecting, but it doesn't. Yeah, price actually breaks above this. Okay, it's kind of a messy one, but this is crypto for you. But then when it reclaims it and holds this as support, I'm then using this as a long trigger, right? Because what I'm saying here is an area that I expect resistance, price to come in and reject. See how easily price kind of carves through it here, right? Now, the thing is, price then gets rejected here at this fair value gap, right? But a different way that you could use it is say, okay, well, if we've rejected this fair value gap here, can we not take the same principles into play? Rejection, rejection. What do we get? Strong close above here. What does price then do? Breaks above, draws down into this fair value gap, and we go long. How do we get our conviction to go long? We target resting liquidity, which is above here, right? So price has drawn down into here. We're within our London session, which is a really key kill zone. We get our expansion. Right now, secondary move. Yeah, this move here. Remember what I said earlier? We're still looking for the same pattern. How do we have conviction? Because our expectation is for price to target this higher. Yeah, because we can see now we've stepped into a buy model, right? Higher highs, higher lows. Price is now respecting the fair value gaps. So we then simply say, okay, well, where's the next FVG in this move here? Which is here. Obviously, again, we would look to break this down onto a lower time frame, so onto the low minute charts here. We then look for a repeat of that setup in there, with our first target being here and our ultimate target being up here. All right. So in terms of fair value gaps, mate, yeah, I think it's a very good question. Sorry, this was answering Yusuf's question here. So if they're quite close by, yeah, then I look for them to become inverse fair value gaps, right? So if they're close to price action here and we flip them from resistance to support, once they've been used as that, then they're off the chart for me. Also, if they're quite a long way back in price action, I don't really count those. Yeah. What I'm looking for here is for recency as much as anything. And actually, I think there was a really good example here of an inverse fair value gap. And what we can like to see with these ones, it's like your real kind of common support and resistance flip. Yeah. So you're looking at it as a base. Our theory is that this is a bearish fair value gap. We expect this to show resistance. So we mark up the equilibrium, which is just the 50% with the Fibonacci. And look, as we zoom in a little bit, we can see here how price respects this so well. So this was a bearish fair value gap. Our theory at the moment, before this price action plays out, is that price is going to draw back and reject. We see we get these wicks, yeah, showing the initial rejection. But then look at this expansion higher, this bullish expansion higher, right? Then price retests the midline here, holding it, yeah, so we're not getting closes below. We can then look for this area to long, yeah, and where do we target? Resting liquidity, right? It just has always made sense to me that that's how the market would work, repricing from liquidity to liquidity, right? Even here, you can see, I think this is probably just a few pips lower. Lows 27,123.2, 27,124.3. There you go. So this actually even dipped into this fair value gap here, yeah? So what I'm looking for is for fair value gaps to hold until they fail. When they fail, if they retest with bullish momentum in this case, we then flip this to a bullish point of interest and we look to long in here. Yeah. So I hope that's kind of answered that, Joseph, without going around the houses too much. Kelly, cool. I did find those. Yeah, brilliant. Yeah, have a look at that. Feel free to ping me with any questions you've got on it, right? And we can definitely cover that on another session. So when I'm placing a limit order, do you place a stop loss and take profit at the time you order? Yeah, absolutely. I do trade slightly different ways as well, Seb. But yeah, let's just say, for example, let's find one of those trades. So as I go into this trade here, right, this is what happens for me. So I've already got my TA planned out here. My theory is that price is going lower, yeah? We failed to run our internal liquidity. See how I'm holding the line across it here? We can see it's just below. So when price breaks below, I'm looking for the dynamic of the move, meaning I want to see this gap, yeah? This inefficiency. So that's displacement. The move showing me strength, that it's moving down aggressively. As it does, when this candle closes, we form and complete this fair value gap. At that very moment, with price down here, I set my limit order on this line, right, which is the base of the FVG, yeah? So then when we get the next candle, so let's just draw that in. So this is the base of the fair value gap. That's where our order is. Right? So that's set when that candle closes. My stop loss gets set up here above the order block. I always do it a few pips above in case you get a little bit of a rogue wick. And then boom, the next candle triggers, yeah? And then we're live. And then we ultimately waiting to watch price play out. And then we're in the trade. All right, bud. So hopefully that's been helpful. Let's just have a quick look. You're very welcome, Davis. Let's have a look. GOT. So did I understand correctly that you treat the fair value gap that has been traded through similar to a breaker block? Yeah, kind of. Yeah. So, okay, this is a good example. Again, in terms of looking at kind of breakers, we'll definitely kind of cover this on future sessions as well. Just trying to see if we can find one here that has triggered. Yeah, I mean, there's an argument you could say. Let's just get rid of that. You know, not the cleanest example in the world, but in terms of looking for a breaker, what you're looking for is liquidity sweep. Sorry, just waiting for this to draw across. So we see here at this move, this is what I'm pointing to just down here, right? So we've had a liquidity sweep from this low, or it can be the local low. Yeah, let's just use that just for example. Now what we're looking for here, right, is the last up candle before price purged that low, yeah? Which in this case is this candle. Right, now this becomes a breaker block, yeah? Meaning that's where the buy orders were. Price has flushed out, taken liquidity. Now if we close back above this, we see we just do here. We close above it here with this white candle, again with this black candle. Basically, as soon as we do that, we open a limit order on this line, yeah, with our stop loss below the prior swing low. right? So with this one, it actually becomes quite tricky because we've got such a long tail wick here. You can get aggressive and place it below the breaker. In this instance, I think I probably would, just because that for me is too far down. Or I would take what's known as consequent encroachment. So we have our first close above it here. Our limit order would have triggered here. You can either take the 50% of this wick, yeah, or you can have a really aggressive stop a few pips underneath the breaker, because technically price shouldn't break back down below this, right? And then we have our initial target here, yeah? See this key and clear and obvious prior swing higher. So that's how you would use a breaker block, yeah, for sure. But really with a fair value gap, it's more about it being looked at in an inverse sense, yeah? So here's another good example. We set this fair value gap here. So this goes in grey. Now, this, if we're expecting lower prices here because we've run liquidity above the high, then we break down, come back, break down with displacement. We expect price to reject in here. However, notice how we don't reject. Again, we follow the process. Go back, put our Fibonacci on there. Oh, not a long position. Put our fib on there. High to low. And look at this, right? Rejection, 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 big expansion, and then look how it's respected here at the midline, meaning that we can then dive down to a lower time frame, because look, we've got our resting liquidity here now, yeah? So we can see we've got a clean pre-made target. This is where stop losses are resting, yeah? I'll do that in a slightly thicker one just so that it stands out. So we've now inversed our fair value gap, which when we do that, for me, I then draw that and make that purple. I'm then just going to show you this one last thing before we shut up, right? Before I shut up. So again, price is fractal, right? So just because we're on a 15-minute chart here, doesn't mean that we can't drop to a lower time frame. In this case, it would be our 1 minute chart or maybe a 2 minute chart. And where are we here? We're inside our London session. Okay, so you notice here, and again, we'll go over why I use time zones and stuff like that as well, but we're within New York here, so a New York PM session. So we want to wait here. We see as we enter the PM session, price is just breaking down, breaking down. What do we need to see, guys? Remember, doesn't change no matter what level we're on. We've got beautiful equal lows here, which is a prime target for a liquidity sweep. We've also swept liquidity below this low, and we're respecting the equilibrium of the inverse fair value gap. Does that not give us multiple points of confluence? It does, right? So what do we need to see? We see price break down. So entry one can look like this. Well, I'll give you 3 entry techniques here, right? This would be a breaker line, meaning that's our shift, yeah? So that's where we break the current trend. We get a strong close above. We open a limit order here. The limit order opens, triggers here, stop loss below the prior swing low, right? Perfect. Or we follow our previous methodology of fair value gaps, yeah? So price, here we have our market structure shift. Yeah, we've got our higher time frame bullish analysis. What are we looking for? Price to trace back into a fair value gap. Entry number 2, yeah? Shift, retrace to fair value gap, entry at the top of the fair value gap, stops below the swing low. Or the third technique that we just discussed is we take the high volume breaker candle. Let me just get rid of the fair value gap quickly just so it cleans it up. So what do we have here? The last up candle before the purge on liquidity. We have an expansive move higher. When we close above it here, our limit order goes on the top of the breaker block, and our stop loss either goes under the swing low or under the breaker block itself, right? So that is just an example of how we can move between time frames. We just did it on a 4-hour to a 15-minute. We've now done it on a 15-minute down to a 1 minute. It's all about framing the high time frame context and executing on a lower time frame. And remember what I said in terms of what we're looking to do for secondary entries, yeah? Now look, if we've missed that initial entry, fine. Where's our main target? Don't get caught up on the 1 minute chart. Here's our main target, remember? The big thick line. So let's say we missed this for whatever reason. We had a meeting or we were away and we've come back in. Well, our target's still here. So where can we look for another opportunity to get in? Well, we want to see the same principles respected, right? So we just want to see a fair value gap. Price now draws down into the fair value gap. We can take a more aggressive approach using a market order, for example, or we can place a limit order on the top here And once again, our stop loss goes below the origin of the fair value gap. So below this low, right? A couple of pips anyway. Yeah, so that's the first candle that forms it. We always want to be below that candle or the prior candle's low. And then as we're targeting the highs, we can see we still get a lovely 2.3R trade. One thing I just want to say here, guys, as well, is just make sure that you understand your position sizing, right? Because it's very much going to affect your fees. The lower the time frame, the more you're trying to get a move. Let's say, for example, 2.3R. Yeah. What I do is, and this is a bit of a shill, right? But it's a very, very good one. So my dear friend and fellow Bird Nest member, Razoon, who's just an unbelievable trader, a wonderful human being, and just an unbelievable builder as well. He built this for all the members at the Bird Nest, right? You can get this just by signing up. You can get it just from coming on for a month for calls only and other bits and pieces. For me, it's one of the most important tools that I use all the time, and it's a position size calculator. So first line goes on your entry. It tells you down here as well. Second line goes on your stop loss. Third line goes on your target, right? And then what you'll see is you get this handy black box down here. And it tells me in this trade, if I've got $1,000 account size, and you can change all of this in your settings, right? But just for an example, if I've got an $1,000 account size, yeah, and I'm using 10x leverage, and I only want to risk 2% of my account, but I want that 2% to represent $20, then it works out the rest of it for me. It means that I have to have an $8,676 position size, right? Which is fine, but what's my P&L? Okay, so I'll win $45 if we hit target, but I still have to pay fees, right? Now my fees could be like 0.15% of that, meaning that my fees could be around $15. So actually, if I lost this trade, yeah, I'd lose $20 because that's my 1R, that's my risk, plus, in this case, $16 in fees, yeah? So actually, my real loss is $36. So if I'm looking to trade this to the high, I need to make sure it's worth it. So the $45 return, yeah, isn't quite as good as it seems off the bat of it because we're thinking only $20. But because the position size is so big, we're paying a lot in fees in terms of keeping that position open. All right. I'll happily run another session on this, guys, and risk management and stuff like that, if that's the kind of stuff you want to see as well, because it's such an important part of how we trade. A little bit of a side note, I know, but it is a really, really important thing to factor in. Django Blue, love that name. Hello, buddy. I'm really, really sorry. We're just literally about to close off the session, but it will be available on recording very, very soon. And if you have got any questions, please don't hesitate to reach out. All right. And Sebster, please could you demonstrate the profit and loss tool in TradingView? I use it for risk to reward, but don't understand the other numbers. No, it's very, very complex, mate, to be honest. I don't use it for that. But there's actually, if you go onto YouTube and type on TradingView, long, short, yeah, or position, yeah, and then what's the word I'm looking for? Instructional video. There's loads of really, really good ones. Some done from the techs on TradingView, other people from like the Binance Academy and stuff like that. But to be honest, I've always found it a bit convoluted. I use it for in terms of pips and points if I'm doing traditional markets. But yeah, I'd recommend either watching one of those or if you can, grab yourself one of these. Nick, hello, mate, as well. Yes, I've got a DM from you that I'm going to pop back to later as well, mate. So I'll catch up with you on that. So look, guys, I really, really hope that's been helpful. If there's anything that you want to see from this in more detail, right, or if there's anything else that you've got that you'd like me to cover on next Monday's more kind of educational based live stream, please let me know and I'll make a point to cover it. But also as well, if there's anything for Alt Request Wednesday, remember, so let's come along with some ideas. We'll take a look. If there's any follow-up from this, maybe let's pick a couple of gems. Let's kind of put some TA on them and see what happens. We've done that for the last few weeks, and we've had some brilliant winners, none, not least of all Litecoin, which I think did 27R in the end. Now, that's not to say that they're our usual trades, right? For me, I'm looking to snipe little 2-3R trades where I can be consistent and have a reasonable win rate. But often, holding on to some of those bigger wins can really, really help boost your portfolio and certainly your profit and loss. All right, guys. So, look, thanks very much. We had a load of people on the stream today, which is always really, really appreciated. Some brilliant, brilliant questions coming in today. Actually, I mean, so much so that it was basically just dealing with them throughout, which is really what I want on a Monday. If there's things you think I can do better or different types of subject matter you'd like to see on the stream, please do let me know. If you're interested in joining me and the team over at the Nest, either to learn or in terms of getting access to our call statistics, which have been crazily profitable over, well, consistently for the last 2.5 to 3 years, and even before that. But I didn't have the data access before that. But in terms of this year as well, it's been really, really insane. Last month we were in the kind of mid 60s, which would have netted a really, really big return. You can get access to that for free just via our partner Bybit as well. So if that's of interest, you can find the details in the description. If not, feel free and please do reach out to me on Twitter or come and take a free trial and come and grab us over at the Nest. All right, guys. Huge thank you to everyone. It really, really was a brilliant stream having you all on. Have a fantastic week. Kelly, good night. And everybody else, good day. Hope you have a wonderful one wherever you are. And I'll catch you all hopefully on Wednesday.